Howdy folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 6674 as I'm speaking. That's up about 13.75% year to date. Market gave back a little bit last week. We've been on a very, very impressive run. Market had a little bit of a sell-off last week, but then closed the day up strong on Friday. And so far on Monday, we're up a little bit as well. A little bit of a rally as well in sort of the 10-year Treasury rate. We were down as low as about 4.05%. We're now at about 4.15%. We're going to talk a little bit about why, but basically up about 0.1% over the last week or two, which is one of the reasons why we saw a little bit of weakness last week in overall equity markets. Those two are somewhat linked to each other. So what's going on? Well, obviously we got a rate cut. And that is lovely. Equity markets were, sort of firmly expecting that. And the question becomes, okay, what are we going to do going forward? And there was a little bit of agita post-rate cut from some of the Fed speakers, particularly Powell, that came out and said, whoa, not so fast. Yes, unemployment seems to be the bigger problem that we have right now. But let's not forget about inflation, right? Because inflation is also a problem. So let's not get too carried away on either side of the ledger. And that put a little bit of a damper on the rate cut party that a lot of people had been betting on. Some people even earlier last week were calling for 2 rate cuts by the end of the year and maybe some more aggressive rate cuts in 2026. That sort of party has been, cooled off a little bit. Maybe we turned on the lights and started to tell everybody to go home because, Powell basically saying, hey, you need to consider both sides of the risks here. And then late last week on Friday, we got PCE numbers, personal consumer expenditure numbers, which are the Fed's preferred measure of inflation. Those PCE numbers actually came in pretty well. So core inflation up 0.2%. Month over month, year over year inflation numbers at 2.9%. Not, as low as we would like them to be. Remember, the Fed's inflation target is somewhere around 2, but not as high as a lot of people feared. And so that, I think, gives the Fed a little bit of leeway to continue to cut rates. I would also just say that, consumption data from that PCE report was actually quite strong. A lot of people revising up their sort of GDP forecast based on the amount that consumers spent, according to that survey. So all of that was kind of a positive for equity markets and a positive for, hey, we will continue to get rate cuts going forward on Friday. One of the reasons why you're seeing the market rally a little bit on Friday and into today is those sort of positive reports. Meanwhile, on the other side of the ledger, we got consumer confidence numbers at the end of last week, and those continue to trend in the wrong direction. People, despite the fact that they're spending money, not feeling great about the overall direction of the economy, not feeling great about the overall direction of where things are headed. And so those survey numbers kind of continue to get a little bit weaker. We are headed towards the lows for the year that we sort of saw in April, May, which is the first time that we announced the tariffs. Just a lot of uncertainty out there in terms of consumers. And that uncertainty has to be concerning if you're the Fed. The other thing that's got to be concerning is the jobs report that we're going to get later this week. That is singularly the largest piece of news information that we're going to get probably this quarter. Most people looking for somewhere around 50 to 60,000 jobs created, which is a very, very low number for an economy of our size. And hopefully, fingers crossed, an unemployment rate that stays right around that 4.3% number. That would be the sort of Goldilocks result. That would be a result where unemployment is not starting to kind of run away from us, which is a good thing, but unemployment still seems a little bit more concerning than inflation does. And so that would sort of pave the way for probably an additional rate cut by the Fed, sometime later this year if we saw a number like that. I think if you were to see very, very strong employment numbers, almost no one expects that, but if you were to see it, that might potentially take a rate cut off the table. And obviously, if you saw very weak unemployment numbers, so that unemployment rate starting to tick up into the mid-4s more firmly, that's going to raise raise the specter of like, okay, have we overshot? Does the Fed need to do something even more aggressive to try and stave off some type of consumer-led economic slowdown? That is what we think is sort of driving the markets. There are a number of other headlines out there. Most notably, we're running into a potential government shutdown. We've been through these before. They typically one-time events, so that's okay. The market will roll through it, as well as we've got some news out of OPEC that they're probably going to, increase oil production. That's putting some pressure on oil prices. The United States, somewhat neutral with respect to oil prices, depending on where in the country you live. So net, none of those things a huge positive or negative. I just keep all eyes focused on that jobs report that's coming out on Friday. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. Hope you're having a great day, and I look forward to talking to you again soon.